Look, if you were trading gold back in March 2020, you probably remember the absolute devastation. I mean, it was a historic plunge that literally wiped out fortunes in just a matter of days. Now, most traders look at events like that and write them off as unpredictable black swans, right? Just bad luck. But what if I told you they're actually mathematically predictable? Welcome to our explainer on the COT Extreme Unwind Framework. Today, we're not just going to analyze the wreckage of that March 2020 gold crash. We're going to walk through exactly how you can predict, measure, and actually profit from these massive positioning resets so you're the one cashing in instead of getting wiped out.
Okay, let's dive into our roadmap for today. We'll cover the anatomy of an extreme unwind, walk through the 4 distinct phases, show you how to measure the unwind progress, break down the unwind prediction system, and finally, tackle trading psychology during cascades. Starting with Section 1, Anatomy of an Extreme Unwind, and the core problem traders face.
To really understand this, we have to look at the historical March 2020 COVID crash as our ultimate case study. Look at this staggering 14.8% plunge, and that happened in just 5 trading days. That is simply not normal market behavior. Managed money net long positions plummeted from roughly 120,000 down to just 55,000. This is your textbook example of an extreme build, where the market is acting like a crowded theater with only one exit door, followed by a vicious, rapid purge. And this brilliantly illustrates the difference between what happened then and your run-of-the-mill market dip. You see, a normal correction is driven by discretionary selling. It's just traders making a rational, conscious choice to take a nice 2 to 5% profit. In extreme unwind, that is a mechanical, forced liquidation. Traders aren't choosing to sell. They're absolutely compelled to sell to cover massive margin calls. This creates these violent cascades of 8 to 15% or more, where the selling just aggressively feeds on itself. So, for an event to officially be classified as an extreme unwind rather than just a heavy pullback, it absolutely has to feature 3 defining characteristics. First up, extreme pre-existing positioning. The boat has to be tilted entirely to one side. Second, forced margin liquidation, which you'll see as rapid price declines and huge block trades. And third, a significant COT data reset, where those speculative longs get violently slashed by 30 to 50%. Moving on to Section 2, the 4 phases explained, looking at the life cycle of these events. Every single unwind operates in 4 distinct consecutive phases. Honestly, think of it like a demolition site. Phase 1 is filling the powder keg, Phase 2 is providing the spark, Phase 3 is the massive explosion, and Phase 4 is the final equilibrium, where the dust finally settles and your next big opportunity actually begins. Now, each phase has a dominant characteristic you've got to look out for. In Phase 1, you're going to see extreme bullish narratives everywhere, with a COT index soaring above 80. Then comes Phase 2, the spark. This is a sharp technical breakdown accompanied by massive block trades. That leads straight into Phase 3, which is pure, unadulterated panic, marked by extreme volume and relentless margin calls. Finally, Phase 4 arrives. Complete stabilization. The panic stops, and we see that the managed money net long has been heavily reduced by that 30 to 50% mark. All right, Section 3, measuring the unwind progress. Let's get into the math. First up is the UPB, which stands for the Unwind Progress Bar. How do you calculate this? You take the managed money peak, subtract the current level, and divide that by the peak minus the 5-year average, then multiply by 100. Basically, it calculates the managed money net long purge relative to the 5-year average. It measures exactly how much of that speculative extreme has been liquidated. Think of it acting literally like a progress bar in a video game. It tells you whether you're in the early, middle, or late stages of the crash, so you know exactly when to time your directional trades. Similarly, we have the PEP, or percentage of extreme purged. This measures exactly what percentage of the peak speculative long position has been totally wiped out. You find this by taking your peak minus the current positions and dividing that by the peak long positions. This metric is absolutely vital for identifying market bottoms. Why? Because historically, across the biggest crashes, unwinds tend to bottom out when roughly 45 to 55% of the peak long positions have been eliminated. It is an incredibly reliable guide to knowing when the sellers are finally exhausted. So, the crucial point here is this number, 75%. To safely enter what we call the completion zone, you absolutely must not try to catch the falling knife. Seriously, do not buy the dip until the UPB exceeds 75% and your PEP is over 35%. Waiting for this 75% threshold ensures the speculative extreme has been sufficiently purged and the washout is genuinely, completely finished. Let's look at Section 4, the Unwind Prediction System, and how we actually execute this. This is where we introduce the UPS, the Unwind Probability Score. This is your early warning radar, specifically designed to predict a crash 1 to 4 weeks out. It's calculated weekly by blending 4 weighted factors. You've got COT Extreme data at 40%, leverage, like ATR expansion, at 25%, trigger risks, say an upcoming FOMC meeting, at 20%, and seasonal weakness at 15%. When you blend these mathematically together, you get a highly accurate, objective signal of when a market reset is imminent. Now, when your UPS rises above 60, you are officially entering the danger zone. Here are the specific hedging steps to protect your capital. First, move to a defensive posture immediately. Second, prepare a pre-unwind short hedge sized precisely at 25 to 50% of your total long exposure. But pay very close attention to step 3. You only enter this hedge when the phase 2 trigger actually fires. Do not enter it in phase 1. The extreme buildup can persist a lot longer than you think, and you don't want to get squeezed early. To stay on top of this without losing your mind, here's your step-by-step tutorial for tracking market health every single Friday. You build a weekly watch list using the newly released COT report. Just check your COT index against the 80 threshold. Calculate if your UPS is over 60. Verify if managed money is above the 90th percentile. And finally, watch for ATR volatility expansion over 1.15. This simple weekly checklist takes all the emotion out of it. It turns a subjective feeling of panic into an objective mathematical defense. And to make your execution flawless, keep this clear action checklist handy for each phase of the cycle. In phase 1, reduce your longs and prep that hedge. In phase 2, the trigger, exit remaining longs and actually enter your short hedge. In phase 3, the cascade, you just hold your short and trail your stop. Let the crash do all the hard work for you. And finally, in phase 4, the reset, cover your short and start scaling into your long positions at a massive discount. Finally, Section 5. Trading psychology during cascades, the human element of all this. During these incredibly violent market cascades, traders inevitably look back and ask themselves, why did I freeze? Why didn't I just sell? Well, it comes down to basic human psychology. They suffer from loss aversion. The physical pain of taking a loss is literally paralyzing. They anchor to past prices, thinking, hey, today's drop is unfair, it's got to bounce back. And they fall into sheer disbelief, desperately watching their once profitable trades turn deeply red without taking a single protective action. So how do you fix it? You overcome this emotional freezing by pre-committing to your actions before the cascade ever even starts. Write your plan down when you are completely calm. When your unwind probability score crosses 60, you execute your defensive plan automatically. You must rely entirely on your data frameworks to guide your hand and completely tune out the panicked financial media headlines. I want to leave you with this final thought. The greatest trades are made when the data says buy and your emotions say run. You now have the exact framework to read the data correctly, to measure the unwind progress bar, and wait for that completion zone. So the question is, ultimately, will you let the next great positioning reset wipe you out, or will you use this framework to claim your mathematical edge and profit from the chaos?